Good afternoon, everyone. Thank you for tuning in today. I am Tanya Tang, Membership and Programming Director with CFA Society San Francisco. On behalf of the Society, it is our pleasure to welcome you to today's webinar, Beyond Active and Passive Investing, the Customization of Finance. Now, a quick item to note before we start. You will be muted for the event, so we encourage you to type questions using the Q&A box. We will monitor the questions closely and endeavor to answer as many as possible. This event will be recorded and we will share the replay. Now, I'd like to introduce Dr. John Ameriks as our event moderator. Dr. Ameriks is the principal and head of the Quantitative Equity Group at the Vanguard Group. His research, which includes quantitative equity investment strategies, behavioral economics, and solutions-oriented single fund investments, has been published in numerous notable journals, such as the Journal of Finance and the American Economic Review. Now, let's give a warm welcome to Dr. Ameriks.
Thank you so much, Tanya, and welcome to everybody here. Appreciate the introduction. It's great to be able to speak with you all out in San Francisco. It is also now my great pleasure to introduce the sort of main event today. And that's Marc Reinganum, who is the co-founder and chief executive officer of Compitium, which is a consulting firm that serves leading asset managers. Marc is himself a leading light in the field of quantitative investing and in economics and finance generally. He is an accomplished senior asset management and academic thought leader whose career is bridged across industry and academia. And so, Marc, look, I'd love you to introduce yourself with a little bit more about your background for the audience.
Okay, great. Thanks, John. Well, before I sort of introduce myself, let me thank the people for organizing and participating in this webinar. A couple of people I'd like to give a shout out to is Melissa McGrain, who put me in touch with Tanya and Glenn. Obviously, I want to thank John, who agreed to sort of moderate and help this along. And of course, Ken Blay, with whom I've spent countless months, days, and hours thinking about this topic. And especially, I want to thank the people that have participated and joined this webinar live, or will watch it on a recorded basis. And as I know, it's sort of hard to keep track of anything other than today in times that are turbulent as this. I was explaining to Tanya and John right before we went live that one of my earliest speaking engagements was on October 19th, 1987 at a conference. And when I began speaking, the room was packed. And all of a sudden, they didn't have cell phones back then, but they had pagers. And all these little pagers went off, and people couldn't pick up their phone and see what was going on. And so people left the room and went to the nearest payphone. So thank you for your attention and consideration today. My career, John, began a long time ago. It's sort of my professional career began at the University of Chicago, and it was so long ago that's where I got my Ph.D. And back then, it was actually known as the Graduate School of Business rather than the Booth School of Business. And my dissertation was on a topic that was that had become known as sort of stock market anomalies. It had the very short title of Misspecification of Capital Asset Pricing, Empirical Anomalies Based on Earnings, Yields, and Market Values. So back in the day, it was about what we'd call size and value. I had a very fortunate career. I began teaching and research. I had a 25-year career in academia where I did consulting as well. I've had the opportunity to serve on investment committees. After leaving academia, I had a chance to practice what I preached, going to Oppenheimer Fund, where I was director of research and then head of the group, and we managed all small, mid, large, multi-cap funds. And then I went up to State Street Global Advisor, where I was head of sort of an active equity group that oversaw global things. And then since then, as you mentioned, I'm now started and co-founded Compitium, which is a consulting firm that helps asset managers refine, execute, and explain their investment edge. You know, I had a fortunate career and continue to do what I love, which is research, discover, explain, and improve outcomes. So hope I didn't take too long, John.
No, thanks for that, Mark. It's great. I'm smiling to myself here a bunch. You may know this. We may touch on it. I know it's in the paper, which I really enjoyed reading on the CFA website. The longer paper is available there. I hope folks have had a chance to take a look at it. But yeah, it's also going to be the 50th anniversary of the Vanguard Group this year, and so in connection with that, there'll be a lot more we hope to do around that as we go. But in connection with that, we were doing a sort of senior leadership talk to the crew, and folks were sharing stories about what they loved from the 70s. Right, so everybody else is talking about bell bottoms and disco music and the Muppets. And I'm talking about all the incredible finance theory and work that came out there. It was kind of the golden age for finance. You were certainly a part of that. So, you know, listening to your story just reminded me of all of that. Maybe what I think is the best part of the 70s. But anyway, let's jump in. You know, you and I've chatted a little bit. We'll do this kind of fireside chatty style, but I'll kick it off with, look, the title of your talk and your paper, Beyond Active and Passive Investing. So did that debate begin in academia? Was it that all start up in the 70s, or what was the real story there?
No, actually, it began earlier, John. Let me put up a timeline that I made. I don't know, it's artistic. And I dated it sort of, it's this part over here. You know, Ken and I talked about this, and we sort of dated the active passive debate era existing even before active and passive funds existed.
Sure.
There was a very provocative paper published in the Financial Analyst Journal in 1960 by two authors, Renshaw and Feldstein, that really threw down the gauntlet. And the title of their paper was the provocative one, "The Case for an Unmanaged Investment Company." Okay, the case for an unmanaged investment company. And this paper was looking at a lot of empirical evidence, including some that they collected. You know, and it suggested that just creating a portfolio that followed a simple market index or average, just some representative market index. And at the time they were talking about the Dow Jones Industrial Average, would sort of be, why don't these firms exist? I mean, that was the question that they posed, because they said, you know, look, this does pretty well relative to what they viewed as managed investment companies, which at that point in time were mutual funds. Well, that paper didn't go unanswered very long. And later that year, an author who published under the name of John Armstrong, who, as it turned out, was the pen name of none other than Jack Bogle, retorted retorted that experienced professional management was a key advantage that mutual funds offered that the average investor couldn't get access to. So it's sort of ironic that sort of no unmanaged investment company existed in 1960. And the irony is that Bogle, who sort of took up the mantle of why you want a managed investment company, actually founded and started one such company in the 1970s.
Yep.
So
I mean, it's just such a great story. Look, there's a lot more to it. Like I said, you know, as we're thinking about 50 years here, the sort of many sides of Jack Bogle's career and ups and downs. You know, people that know the story know that, you know, Vanguard was started in 75. The first 11 funds we offered were on the active side in partnership with Wellington Management. That's a partnership that continues today. You know, very soon thereafter, you know, the passion of Jack's career and, you know, what I think he really sees as his legacy was the development and implementation of an index strategy that, in my mind, we're going to talk a lot about active and passive. We'll talk about the best aspects of passive. You know, he built that in, but also borrowed a lot of what he talked about in that paper about the benefits of a professional manager actually being careful about transaction costs and taxes and all of the mechanics about how you would manage a fund. I think his heart was always in the goal of tracking the broad benchmark and giving people that sort of market consistent average over long periods of time that increasingly over time has proven out to stay ahead of the vast majority of active managers over time is really kind of where he ended up. But as you're informing everyone, it's not quite where he started if you get into the details.
Yeah, and in that's not where his head was in 1960.
Correct.
And that's why we sort of put, that's why, we would sort of put 1960 as the year that sort of this debate began. And, we can put it into sort of, on this timeline here, sort of this active passive component really towards the end of it. And I don't want to spend much time on it, but there's a history of funds, because we're talking about funds in both cases. And, the history and the evolution of funds is an interesting one in itself, how they came to be and why they came to be. There was a financial credit panic in 1772 that was based, and it was sort of based over in Europe, and a lot of it had to do with sort of in the failures and the interconnectedness of Dutch merchant bankers and their overexposure to the British East India Company, that they weren't diversified investments. And shortly thereafter, a Dutch broker, Abraham van Ketwich, created a pool trust. And in my research and others, this is like the first example, at least in the West, that I've seen where you had the pooling of monies across diversified investments. It was in sort of a closed-end format, and that was back in 1774. And these type of pooled vehicles really didn't spread to London and the USA, until 100 years later. So it's not like financial innovation is instantaneous, right? I mean,
yes. And we'll come back to that, I'm sure, as we get to kind of the more forward-looking aspects of kind of what we've got to talk about. But kind of bringing it back to the tail end of your timeline, maybe we can jump in a little bit more on how academia contributed to all of this.
Yeah, sure. Well, I think it contributed in two ways. The academic models, I think, were in the 1960s, and I would highlight a couple of different academic contributions in 70s. There was the development of the capital asset pricing model. Okay, and let me say that academia, I think, contributed and sort of set up both the passive side and the active side. Okay, on the passive side, you have this capital asset pricing model that had a result that the optimal portfolio for all investors was the market portfolio. That investors only needed one portfolio of risky asset, the market, and then based upon their risk preferences, they would combine this market portfolio with the risk-free asset. So, that was a very powerful thing. And in terms of, the work earlier in 1960, it said, no, you don't just want to use any index. You'd like to use this cap-weighted market index. So it defined the market, as all assets would be weighted in proportion to their market values. Another sort of academic trend in the 1960s that gave sort of additional oomph to this passive push, in my view, was the work on efficient capital markets by Gene Fama, that prices sort of fully reflected all available information. And then there was some early research by Michael Jensen as well, on looking at the performance of mutual funds. And he said, gee, they don't really seem to do that much better. They don't seem to add any extra. So the academic side certainly addressed the passive side, but I think it also gave rise to the active side, because the same model defined alpha, right? I mean, people talk about alpha, this measure of, risk-adjusted excess return. There was no such thing as that, before the CAPM. Maybe people would compare it, how are you doing relative to a benchmark? But the CAPM really gave a very precise definition to alpha and, risk-adjusted excess returns. So that came out of academia, as well as some evidence that came a little bit later in the 70s. And this is sort of the strand of research that my research, picked up on, which was stock market anomalies, the size and value. So it turns out academia, addressed both sides of the coin.
Yep. Oh, plenty of fuel for both sides of the fire. for sure. And kind of going back and forth and delving into this has been part of both our lives for so long. But you mentioned very quickly sort of a definitional aspect there. So I want to go back to that.
Yeah.
All in all, the academic literature are probably very precise about what we mean by active and passive. But I find it's sometimes difficult to talk about this with clients. Do you have a favorite definition of active versus passive? How do you define those for people that are investing, or just what's
Yeah.
the most useful definition?
Well, I don't know. I mean, my view has changed over the years. When I was a PhD student, it was a very precise definition, very theoretical and precise. And in my view, in simple terms, active investing is allocating a slice of your capital, a slice of wealth, to price discovery activities, to price discoveries, in the belief that some assets are mispriced and undervalued. Okay. And passive investing, in my view, is rooted in the view that the performance of widely diversified portfolios are a good enough approximation to sort of achieve long-run outcomes, and that current prices are generally correct. I mean, it's sort of like a first-order effect. You can get it first order. And when I think, thinking about it a little bit today, I thought about Aesop's fable. Okay. These issues sort of go back long time in history. The fable of the tortoise and the hare, where the moral of the story was sort of slow and steady wins the race. You had the hare and the tortoise, and the hare was sort of, glamorous and fast and going this direction and that direction. And the tortoise was sort of, was plodding and slow and stayed on the course. And I think in some sense that captures the essence of what active versus passive is do you think that you really have, how much confidence do you have in your ability, or how much of your assets, your own personal wealth, do you want to allocate to the belief that you can identify a mispricing? Now, in terms of just one other thought on that. In terms of explaining an action plan to clients, because we know when I was sort of portfolio manager and managing teams across the globe, and I would have to sort of extol the virtues of active, because that was sort of where I lived in the investment sphere. But I think today, I don't think I would ask clients and tell them an action plan that this is what you should do. Sort of ask them and not tell them. And in particular, I would ask a simple question. I would just ask, how much of your wealth would they like to risk on hitting investment home runs versus living with general returns of a well-diversified basket of risky assets? So that's sort of, I don't know if that's full circle or if that's a non-technical term, but that's where I've sort of come to see it as, John, is as active as you have strong beliefs that there's mispricing and you can identify it, which I should say is why, a little tangentially, I think that there's been often criticism of sort of active funds, because the views that they veer so little from their sort of underlying benchmarks that they're not necessarily giving you that full price discovery effect. But anyways, you, John, have thought about, I don't mean to dominate here, but you've thought about this a lot, obviously. I'd love to hear, and I'm sure the others on the call would love to hear your view.
No, well, like a little bit. I mean, and sort of steeped very much in more than 20 years here at Vanguard. I appreciate the definitions there. I always take a page, or try to, when I can, borrow Mr. Bogle's ideas, and he'd always talk about the logic behind an investment portfolio or an indexed investment didn't have anything to do with finance theory. It was just basic arithmetic. And so my definition of kind of the passive piece is, hey, pick your broadly diversified market, and a passive portfolio is what's going to deliver the return of the average dollar in that market. So do you want to do as well as the average? Do you want to keep up with the average? And I think for mom and pop and for clients, that works really well. When you're giving somebody an indexed investment or a passive investment, I think that's what's in their head. I want something that kind of delivers me the return of the market. And then kind of very much akin to what you've said, if you want to go the active route, you kind of have to take this pledge of, I like to at least ensure that investors understand that, okay, if I'm not going to do that, I'm going to lean one way or the other. I'm going to make some kind of a bet or some kind of an attempt to outperform that. And how much risk do I want to take with that? And what mechanism really appeals to me? You know, we do have a lot of debate around active versus passive. You know, I think passive is pretty well defined as that thing that's in the middle. Active is the opposite things. You know, it's one side versus the other. You have to be much more specific when you talk about active. But you know, for passive or for index, that's kind of the way I think about it. You know, and you talk in your paper about the evolution of strategies over time, and I think we're going to talk a little bit the whole nature of what you're talking about here in terms of customization and what the future is going to look like. Probably does get at that. Like, how much do you want to deviate from average, and what should that look like, and how specific should that be?
Yeah.
But before we get there, let's go back 1 second. Maybe a little bit more insider Vanguard info. But you know, in '76, Vanguard did launch the first index mutual fund with $11.3 million in AUM. By 1989, that fund was up to 1.8 billion, which, given where things are these days, doesn't sound like much. But maybe you can take us through a little bit of what's happened in the industry. I know you do this in the paper, but hit the highlights for us since 1989.
Oh, great. Thank you. And, you know, and I appreciate that, you know, as an empirical matter, you know, there can be lots of debates about what a passive fund is. As a practical matter, Ken and I used Morningstar's index classification, right? And it's not perfect, right? It's not perfect. You know, for example, among index strategies, there was smart beta or strategic beta, or, you know, versus core beta. So there can be, I don't want to sort of, you know, veer off too far. So it's not
Sure.
perfect, but nonetheless, let's look at some data. And I think, let me see if I can get to the slide. I like to put up a slide about since 1989, this is just a slide that looks at the growth of AUM, and it's deliberately not labeled, okay, deliberately. And it shows active versus passive. And so this sort of shows the popularity of, you know, 85% active, 15% passive. And so the question is, you know, that may not jibe with your sort of your intuition and what you're reading. You know, what can this possibly be a graph of? And it is a graph. And, you know, our data in the monograph just went to 2021. So what's this actually a graph of in the active passive world? Well, it's actually a graph of worldwide AUM of index and active funds. So worldwide meaning all regions, you know, US, EMEA, Asia. And it's in all asset classes, except equities, okay? So, you know, very important, you know, point to recognize here is that, you know, equities, you know, your perception of sort of the growth and the dominance of index investing and passive investing, you know, is probably not driven by all these other asset classes. Rather, it's probably driven by this asset class, which are equity funds. And this is a graph of only equity funds. And the data for this slide ended in 2021. And you can see, you know, at that point in time, it was about a 50-50 split, you know, active versus index. You know, since then, I think it's probably flipped more. I think it's probably gone more index versus equity in the last remaining years. But this is very important to see that it's an equity thing. And we can go, John. I don't know if I want me to.
Yeah. No, I would like to, you know, I think it's a really important observation around the difference across the larger asset classes. But we know it's also, it maybe does touch a little bit on our debate before about what's active and what's passive. But when you look at subcategories, this trend also doesn't hold up, right? So, you know, do you see it? Where do you see this indexing trend? Where don't you? Is it true for all regions or categories of equity funds? Or, you know, it does look a little bit different depending on where you look.
Yeah, it absolutely does. And so I don't want to go into all the details of the research, which looks very much in different asset classes and different regions, and there are differences, but let me just sort of highlight one. And I'll just focus on equity, because that's sort of the one that showed this trend. And Morningstar breaks funds up into different categories, those focused on US equity, global equity, regional equity, sector equity. And you can see that the only place where actually indexing as AUM by 2021 had exceeded active was in the category of US equity. Okay. But even that's a little bit too broad. Okay, that's even a little bit too broad. So we take a look at that US equity category and say, is all US equity the same? Okay, that is focused on US equity. And the answer is they further divide, for example, into categories that you might think of as large US large blend, US small cap, mid cap, US large value, US large growth. And you can see that the indexing story, that the passive story is predominantly focused in the US large cap blend space. Okay. At the end of 2021, there are more than 3 times the AUM in passive funds, index funds, than there were in active funds. I mean, investors have clearly demonstrated a very strong preference to this. And a lot of the research that you cited before, John, about index funds outperform the active funds is this. My great fortune or misfortune is that some of the portfolios I measured and managed were in this large cap blend category.
Yes, well, you're I've had the same experience, and we do know that those markets are incredibly tough and tight, and you have to have a great process around that. And look, like the revealed preference is what it is. Although I want to make sure we get to some other things. Maybe we'd have a longer conversation at some stage about just the whys and the wherefores around how this happened, and maybe why it hasn't happened in some places. So, a pet theory. I know there's some people very excited here about hoping to get the Vanguard name out, the Vanguard story much more broad than the United States. Vanguard's been a largely US phenomenon for many years, although we're continuing trying to grow, and those industries are a lot different. The other piece is just some of the segments where, there does seem to be a lot less robust price discovery, a lot more opportunities for someone who knows how to do this and knows how to do it well to add value. There's also a lot of opportunities to blow yourself up in those less efficient markets too. So a lot of people don't talk about the other side of that. But one thing I want to clarify for everyone too, I believe the numbers you're showing us do include ETFs. So that's a big part of it. When you say funds, you mean open-ended funds, including ETFs. There are some closed-end funds and other vehicles that aren't in there, but it is covering all of them. And surely the growth of the ETF is a large part of this story.
Right, and that US blend, I mean, the largest pools of funds are in those, the Vanguard, has huge assets in that category.
I think that's right. I always I talked a little bit with Jack over time around the growth of indexing, and it's been a great success story for investors. And I've loved just watching the price fall of delivering that kind of a solution for everybody. But I always used to have a little back and forth on whether it was really the indexing idea or the usefulness of the vehicles into which indexing was being, the things that were built around indexing. Target date funds, we'll talk about that in a bit, I guess, or something that looks like that. The ETF itself really was built on an indexed chassis. And, that may be part of kind of what explains a lot of this growth is really useful things that are built on an indexing foundation. And that is starting to change a little bit, right? So, maybe we can start to turn toward that as you look forward. Let's we stop, take a minute. I mean, it's an incredible change in the industry, but what's going to happen from here? What changes do you see in trends going forward?
Yeah, let me go to that, John, and let me just point out before I leave this one slide, that this is it's not a US large cap issue, right? If you look at US large cap growth category, most of the funds there are active. It's all right. It's not US large cap. It's just this blend category that we see.
It's once you get out of that, I'm trying to track the aggregate market idea.
Right. So what are some of the other key results that we see? Just to be brief, we think that hyper customization, the technology, advances in technology, and technology and economics has always been a big part of what's of evolution in the financial industry. I mean, what's available? I mean, the creation of an index fund, John, as you talked about the 1970s, right? I mean, that was not a trivial technology task back then.
Yeah.
I remember when big data was just the crisp tapes and
Oh yeah.
and so, but this is going to, we think that the advances in technology are going to allow for sort of hyper customization of portfolios of individual securities that respond to to the unique needs, goals, tax requirements, and other priorities of individual investors. I mean, it's a great idea, this well-diversified basket of assets, but it's one security, right? It's just one. It's like a take it or leave it solution. Take it or leave it. That's true whether it's a mutual fund or an ETF. And with this advance in technology, we see that passive index funds, especially those in the U.S. large cap blend category, they're somewhat at risk and could very well be disintermediated by sort of hyper managed separate accounts. And I love this little image that I found, a cart sort of putting apart. You have 500 securities. Well, how close can you have to matching the performance of those 500 securities? If you can incorporate some taxes and personal priorities, I mean, you can become pretty close to that 500, which I think is going to be, will have outcomes that I think investors will prefer. And we'll see that in a moment. We'll see why that might be in a moment. And then other thing result is that we think the active passive debate may just become irrelevant. And I put a cassette tape here. It was great in its days, but in some sense, I think the value added offering of being able to customize and tailor a portfolio at low cost. So we're not disagreeing that low cost is an important component, but at low cost, will improve outcomes, and it's going to improve relationships with asset managers and their advisors. And I think these are where we think the industry is headed to much more. This is why we talk about customization. We think it's much more going in this direction. And it's not, sadly, at this point in time, it's not like really a forecast. When we were working on this, it was sort of like, it seemed like it was ahead of its time. But this is, I pulled off of websites today. There's TIA Cref that was, every time I was an academic for years and had their funds, and every time I log off, their ending slide is get personalized advice in 5 minutes. Fidelity, direct indexing, Russell Investments, direct indexing, the smart strategy advisors can't afford to ignore. 2025, Vanguard, empowering everyday investors through voting choice, Schwab, BlackRock, all the big players are now sort of in there, and sort of trying to solve this problem. And we'll talk about some of the issues of the problem, but they're all trying to solve it. And that we've had some of this before. We've had customization, the asset management. You in some of your work, you've worked on these things. I mean, now everyone's talking about sort of tax efficiency. I mean, that's not new. Target date funds. I mean, target date funds, right? I mean, extremely popular, extremely successful. But again, it was sort of broad buckets, like when do you expect to retire? And for that cohort, they said, this is what we think you should do. And sort of what customization is about really is about narrowing that cohort down to one, right? Narrower and narrower and narrower. And our belief that this is going to happen and be inevitable, we take from another technology example, which is the iPhone. Consumer expectations have been reset. you have 1.4 billion iPhones, and each one is unique, because it's customized by the owners with their app suited to their unique requirements and interests. And we think the same path is going to happen in asset management, which is,
Mhm.
a fairly substantial change.
Oh yeah, no, it's a huge change. I like this example a lot, both because the iPhone is what it is. Everybody's very familiar with that, and this is very true that each one is unique with components that have an ecosystem that's developed over now a decade or more, to try to allow that customization. The same kind of thing will have to occur, but it's also an iPhone in the end. You remember these, Mark? I know I do. The big tan phones that you used to hold with the giant antenna at the top, like the
Yeah.
functionality is very similar in terms of its usage as a phone, but these new customized entities allow you to do so much more than what the basic phone did. In the end, I'm still very much a big fan of the basic diversified pool of product. It ends up being incredibly efficient, gives people, as we talked about, these beta exposures. But as the tools get better, as customization gets better, Vanguard is a big believer that for certain investors, customization of a portfolio, respecting particular tax situations, trying to design funds that are more well adapted to changes in how people's risks and perceived risks vary over time. All of that is going to be very, very important. And one does hope that as this ecosystem gets to scale, I think Vanguard's ambition is to continue to work on driving prices down and trying to do that in a way that adds the most amount of value that it can for clients. I mean, it's a little bit more challenging because, as you said, everybody's different. How you're going to measure how satisfied you are with the customized portfolio you have may not be entirely about how well it did versus the broad-based index, and that is still in the industry sometimes a challenge of people. A large segment of people see their advisors, see their financial consultants as being hired for one reason, which is to add something on top of that baseline benchmark return.
Yeah, for sure. For sure. I mean, it's a big change. And at the same time, you can have basically that, and I'm certainly all in favor of low cost customization, right? I mean,
Yep.
that's where the technology comes in. It's a challenge, and it's going to raise the table stakes for active managers as well, because people are going to. Go ahead.
One of the other questions I had for you, we kind of chatted just about this briefly, was, as you look at this transformation that's going to happen, I mean, client expectations will change. Maybe the nature of what we're providing as investment professionals are going to change. I wanted to know from you, this move towards customization, are there implications for people that are kind of maybe earlier on in their careers than both of us are? And, what kind of things do they need to be thinking about? We may have some of them joining us today, or kind of enthusiasts and looking to learn more about what the future's going to hold.
Well, I love that question, John. It's a great question. And on an abstract level, not so abstract, my answer would be that young professionals need to develop what I would call research intelligence and the capacity to continue learning. And by this, I mean the ability to structure questions and answers in a way that's likely to yield new insights. I know that sounds sort of abstracted, not very helpful, because obviously at the beginning of one's career, you want to exhibit a state-of-the-art skill set, right? And a nose to sniff out interesting questions. I mean, that's what's going to do. Do you have a state-of-the-art skill set? I mean, that's what we did as PhD students, right? We knew all the latest techniques and models and methods, and then the dissertation was, could we find an interesting topic to sort of use those techniques? But as you and I both know, what is considered state-of-the-art at the beginning of one's career, may become banal and ordinary later on. I mean, I think of myself, I wonder sometimes if I became a quant Not so much because I love finance, but because I really enjoyed working with computers and Fortraning programming and big data, that area, which was the CRISP and CompuStat tapes. I think of today that, Fortran is long gone and big data is so much more than structured numerical data. But seriously, understanding good experimental design and asking probing questions still remains very relevant.
Yeah, that was I'd love to hear that. That's a great answer, Mark, and right where my heart would be on this. I mean, as someone who kind of came to finance through the economic side of things, was always like, what are the interesting questions we need to answer? The problems were always, can we get at the theoretical underpinnings? What type of solution would really make this client better off? How would we talk about measuring that? Can you think about welfare more broadly than just excess return or value added above a benchmark or alpha? How are we going to do that in a compelling way? Years ago, we used to talk about non-pecuniary utility. That's just not going to work with a client. So, again, anybody looking to build a career needs to know what questions to ask, how to come up with solid, well-baked answers for that. And then it is going to get more important, I think, to be able to explain them in a compelling way to a client base that is just going to need a lens for evaluating, well, how well are you doing for me with this customized solution? It's quite a challenge.
Yeah, it is quite a challenge. And I think that, I think it's just an evolutionary step and that, that young professionals, need to really ponder what their comparative advantage is and the competitive edge for their firms and how are they likely to thrive in an ecosystem that may be moving away from pooled investment vehicles, right? I mean,
Mhm.
that's a big change. So, I think you have to ask, what value do you add? And the sort of flip side of that is, how do you get compensated? How do you get compensated to that? And plus, I would say anyone starting today or near the beginning of the career, recognize that in 20 years from now or so, any creative, innovative, useful solutions that you're likely to develop today will probably be commonplace and part of the conventional wisdom then. So
Yep.
there are expiration dates on innovation, but just remember that imitation is the highest form of flattery, and keep going. That's
So I guess kind of maybe it is along those lines. I'll give you one more question, and then maybe we can. I got a question in the chat. I can give you as well, and then I will just remind everybody, if you have questions for us, please pop them in the Q&A, and I will read them out and we'll go through them. But I think you've seen it all. It's already happening, as you're saying. So I think the directionality of what you guys are talking about in the paper really does feel compelling. What are some of the more sort of practical hurdles that you see in terms of what do providers and firms really need to address to kind of make this easier for everyone? I mean, beyond, we talked about a couple of them, I suppose, but anything more to add?
Yeah, let me first of all, let me say I'm sort of shocked to be sort of so close to a trend that seems to be upon us. I mean, I go back and think of my early work, and it was 10 or 15 years before people actually took size and values seriously. Um, Whereas now I think that there's clearly this customization trend is underway. So why not before? Because clearly people like customization. I mean, they like liquidity, they like low cost, they like diversification. So historically, it must be that pool funds provided, there were barriers to moving away from a pooled fund, right? I mean, that the gains and the cost advantages of pooling exceed the potential benefits of, unbundling. So what swung, what changed? What might hyper-management stress? What swung the pendulum in favor of pooled vehicles will be the same issues that I think need to be overcome. There were advantages in trading. Okay. There were research advantages. I think those are sort of disappearing because of the availability of information. There were operational. There was custody issues, regulations, oversights, distribution and access, all the things that Jack Bogle wrote about in 1960, right? Were
Yep.
sort of why you wanted to go to management. So, what do you have to overcome? I think trading, with customization, with a large pool of funds, there's still trading issues, but you don't have to worry about prioritizing trades and treating everyone the same. Everyone implicitly is treated the same within that fund vehicle. And now you're going to have lots more individual accounts, separate accounts, right?
Yep.
So trading is going to be an issue. Custody is going to be an issue. I don't know that the large custodial banks are up to the task yet. And I hope they get up to the task. Both in terms of like fractional shares as well as number of accounts and reporting. I mean, that's the sort of the plumbing of the financial system. So the custodial banks, I think, need to make headway. I mean, some firms already, for like the S&P 500 will on their own side of the equation sort of offer trading in fractional shares. But I think the custodial banks, need to move there, and operation in general. I mean, we're talking about, a scale of going from, institutional pooled vehicles to like millions of separate managed accounts. Okay.
Yep.
And that's got to prove, an operational challenge, regulation and oversight. Will there be guardrails on individual choices? And, that, any of us that have managed institutional money,
Yes.
that there's
Yep.
always a fiduciary. When are they going to sort of stop in and step up? Distribution, I think distribution has great opportunity here. I mean, what better opportunity to get to know your customer, right? On the other hand, you have to develop tools that allow them to deeply understand the goals, objectives, and preferences of many individuals at scale, so maybe you and I wouldn't be as comfortable as that as, our kids might be, sort of interacting with technology to do that. And the way I think it's probably going to go is you have to have this customized portfolio construction at scale. I think in my mind, would be that you first work on the index. You sort of get a customized index because you know what the weights are. You then can talk about current active funds and how you customize active funds. And then ultimately it's them both. But there's going to be an upending of the ecosystem, John, and most of the process, and there's going to be this process of unbundling pooled vehicles, and it's going to be a great opportunities for some firms and treacherous waters for others.
I completely agree, and I think the good news, again, going back to people, mid-career, early on. I mean, there is plenty of work to do. I mean, when you listen to the list of things that you've talked about, it's not like all of this is going to go away. I don't want to open the big AI box, but there's going to be plenty of important work that needs to be done to kind of bring all this about, even if we're right on the trend. So, listen, well, there's one other slide that I definitely wanted to make sure that you got a chance to show us, which was a little bit of a funnier one, if you got time for it.
Yeah, this just gave me a giggle about customization, and I don't know I don't know how well it can show on your screens, but it's a waiter talking to a couple at a table, and he's repeating back the order. And he says, "She'll have the salmon, and you'll have the chopped salad. With so many substitutions, it's now chicken piccata."
Yeah.
So
well, hopefully he'll be very happy with what he gets. He looks a little concerned, so that's good.
So anyway,
we did get. Go ahead, Mike. Sorry.
No.
I was going to say we did get two or three questions here, so I will give you one and continue to encourage the audience to submit them. We still got about, I guess, 10 minutes or so, but looking at the ratio of active to passive in U.S. equities, broken down by size or style, initial reaction is that it mostly seems to make sense based on performance. The exception in my mind is a small amount of passive in U.S. large cap growth, which is a space where I found active managers generally don't do well against the index. Have you looked at how well the active versus passive AUMs correspond to performance?
Oh, I appreciate the question, and we thought a lot about that, and that was going to be a whole nother research project. It's a good question about performance, so I respect the question a lot. And all I can think of, I don't know what the answer is. I can't say that the active has had better performance than the index, or not. Clearly, there are different skills, you know. In the growth side, there's not a lot of history often. I mean, and being sort of having been a quant manager in my past, short histories are hard to analyze, right? When a new firm comes into existence, how do you treat this? So maybe in part it's based upon a bias that people think it's just harder to analyze sort of newer growth companies, that there's not a lot of track record or data, and so they trust human judgment better. And plus, it's an area where algorithmic methods and quantitative methods struggle a little bit. Remember, like, especially I was thinking when I was managing like these new biotech firms, right? I mean, those are very hard to evaluate, right? So
Yep, and then that again, subject for another day. But as the AI tools, I mean, a lot of times in the growth space, it can be about storytelling and what's more effective. Two pieces are: is the story believable? It's still a story. This is all things that are going to happen in the future. So how good is the story? How rational is it? And then the second piece is, well, how much does that appeal to investors? And I mean, let hope triumph over experience, that we'll find something useful in the space to be helpful there. But it's been a challenge. Let's see if we can get to another question here, though. Some market commentators characterize the growth in passive as creating a less efficient market, more likely to fall subject to manias. When the U.S. large cap equities report to have more than 50% of assets passively managed, does that include individual equity holdings, separate accounts, and/or hedge funds?
So is I take it that the question, John, tell me if this is what your understanding is more goes to indexing. Does this sort of make markets sort of less informationally efficient? And
I think there's two. I think it's that question plus a little bit more, maybe, Mark, on what's in the charts that you're showing. Again, kind of back to that topic of what are we including when we say, more than 50% of the fund space is passive. What did that include, and what did it exclude?
it excluded money market funds, first of all.
Okay.
We excluded money market funds, but pretty much it included and closed-end funds
Right. And then
But
the questioner also asked about individual equity holdings, which won't be a part of that, and it's not going to include hedge funds either, correct?
correct, unless they're right. It's not going to be sort of private hedge funds. This is sort of publicly,
Right.
What was in the Morningstar, data set.
Okay.
And does it make it, is the question, does it make it more volatile or less volatile? And, all I can say is that there was a lot of volatility before 1976, before 1990, right? I mean, 1990 index funds were not very big. You had other issues then, right? I mean, you had sort of the 87 crash, you had 29. I mean, you had, back in history, you've had sort of financial panics and crashes. So I don't think index funds sort of really contribute to that. Just because there's index funds doesn't mean that there aren't individuals out there and investment pools that are trying to sort of exploit, that are dedicated to price discovery. They don't have to be very big, right? I mean, they talk about some of these hedge funds, 60 billion, 70 billion. Well, that's certainly a lot of money in my pocketbook. But relative to the size of a Vanguard mutual fund, it's small. It's
Yes.
small. So it doesn't take, I remember when I was studying economics, there was how many competitors does it take to make a market that, to reach equilibrium and have fair prices? And the answer was one. You don't need a lot to get right prices. John, maybe you have thoughts about that.
I mean, that would be a sort of what we get asked this question a lot at Vanguard. You almost can't avoid it. Again, look, it's sort of an incredible way. The growth of indexing has been really helpful to drive costs down and deliver market consistent returns to just enormous numbers of people over time, and created a lot of wealth. Does it have an adverse impact? all of the things you said are things that we talk about quite a bit. You know, the degree to which folks are involved in the market, the degree to which, you know, there are still very large, very active shops in the market on a daily basis, doing the work and having the interactions to set prices. I just, if you're not in the markets every day, maybe that's something you don't see. What you see is the flow and the growth of these funds, but the mechanics of the way the markets work seems to me, you know, to be as healthy as it ever has been. You know, my response on a lot of this is the markets are right now, the public markets are so incredibly healthy for investors. I think they may have gotten a little less healthy for a lot of people providing investment services. And, you know, I think that's a function of the degree of extreme competition that exists within them over time. And so that is one thing to keep in mind as you see these stories that arise from time to time on sort of the invidious effects of indexing. You know, look, certainly at some point, you can't have a market that's all indexed. We know that. But as you're saying, it takes active investors who are dedicated to it, and not very many of them, to set and move prices in what can be a pretty efficient way.
Yeah, there's, you know, you can, and one of the interesting little footnotes in this research is, you know, people can ask how far can you go with indexing? You know, 100%, you know, maybe doesn't make sense. But we looked in Japan and, you know, in that region, and Japanese domiciled firms with Japanese equities, the ratio is not 3-to-1, it's 9-to-1. I mean, how much more space is there for indexing type investment? I would say a lot.
Yeah. Yeah. And, you know, I go back to maybe this again is a little bit of, you talk about the interplay between what happens in the industry and academia. And, you know, all of the work that's been done over the years, talking about an equilibrium that exists between the information that an active manager can uncover and what might be ignored by an index fund investor, and, you know, the ability of market-based systems when they're allowed to operate and with few constraints or few meaningful constraints, you know, that equilibrium will get restored. I mean, where there are opportunities out there for active managers to seize them, it certainly doesn't feel like there's anything in the way of doing that. And you know, I think that dynamic is very much alive and well.
No, I agree.
Yeah.
So, you know, but and this again, I think there's going to be many opportunities, and I just think, you know, we just have to be aware that, you know, it may not be next year, but, you know, in 5, 10, 15 years from now, we're going to see a much different way. And, you know, we're going from, and I think the overall, we're going from sort of asset management as product to asset management as more of a service and a set of tools for investors.
Yep. No, and I think it's a great trend for investors as well. You know, again, provided, you know, the competition continues, and, you know, the value of the services being provided are going to exceed their cost, and the technology is what is allowing firms to do this over time. As the technology improves, there's more and more we can do on the customization side that literally makes sense from a cost benefit standpoint. So it is a really exciting time. I mean, as somebody that runs active strategies at Vanguard, which is, you know, almost routinely known for what we do on the index side, it is exciting to me to hear kind of us going back to the sort of longer term legacy where, you know, there was this combination of both approaches, and it really came down to the question you talked about, which is, you know, what type of strategy do you wish to pursue to try to outperform, and how much risk do you want to take with that? Like, getting a client a good answer to that question, you know, certainly seems like a valuable thing to do. And the whole thing is the technology and the infrastructure evolving in a way that's going to allow us to do that for more and more people effectively. So I'm as excited as I can be to see us all work toward that.
Yeah, and I think that the technology and the, you know, the AI components of it is not just going to be from the asset management point of view, but it's actually going to be for probing investors too. I mean, it's sort of helping them discover who they are. I mean, you know, who they are and what their real preferences and risk tolerances and, you know, other concerns might be. So, you know, that's something that we may not at this point be, you know, totally experts in. You know, we're interested in the delivery of products and the delivery of these services. But there's another point which is sort of probing investors, and I think that's an exciting avenue too for the future.
Well, I'll give you one more question if we can slip it in, Tanya, and that is, I wonder if the sort of prior question, which is when we were addressing about manias and exposure to manias in the markets, does that have more to do with whether passive funds are inherently overexposed to the momentum factor and forced to chase winners as AUM flows in, creating more concentration in mega caps and bidding valuations to levels that aren't sustainable? Anything you want to say on that?
Sure. I mean, we see, you know, the evidence is pretty strong is that, momentum works until it doesn't. Yeah, and then it's usually,
Yep.
then it sort of usually drops off, as a factor, as it drops off the cliff. But I don't think, I mean, people can do momentum investing without index funds. So I think I think they're really two separate issues. I mean,
Yep.
the impact of momentum investing is one question, and is it a smart strategy versus index funds? And I think that they're really two separate issues and wouldn't be prudent to sort of combine them into one.
Yeah, I agree with that for sure. And I heard that story before. I always remind everybody, the large index funds that we're talking about, the large cap ones in particular, they're buying all the stocks. Like it comes in, it gets spread across everything. So there's a bit there that you got to think that logic through. So one more here, Mark, quickly, because I think it does relate back to maybe a little bit of customization, why it's so important. But so would both of you mind providing your simplest definition of investment risk?
Simplest definition of investment risk. Well, it goes back to my very basic training where I think about investments. And investments was always taught in the context of there's investments and there's consumption. Ultimately, we're, in theory, you're not sort of investing and getting return because you like return for the sake of return. You like return because of what it allows you to consume at some future point in time. So, I think that the risk is that you're unable to sort of meet your consumption and lifestyle objectives, and that's the risk.
And I think that's fundamentally kind of where I'm at. It's almost, the academic risk and its tie to standard deviation has been there for a long time. I think intuitively a lot of people think of one side of that distribution. The problem is that the distribution, while there are some issues in the tails, it is two-sided. And so actually thinking about volatility as a whole thing, as opposed to just downside volatility, it doesn't make a huge amount of difference for me. But investment risk, again, the probability of loss. But then there are the things that Mark is mentioning now, where there are goals and objectives that may not be explicitly tied to performance when you're putting together an investment strategy. Lots of literature out there on trying to build an investment portfolio that might offset or diversify risks that are not they're part of what you can't get rid of. They're inherently part of your labor income stream, or something else that's much harder to shed than simply taking a position, opening or closing a position in the financial markets. And so it does get a little bit counterintuitive sometimes, where actually a loss in a portfolio might be offsetting something that was happening elsewhere. So it's not, it doesn't look as bad or feel as bad to the investor as one might think. So the simple definition is, you failing to meet your goals is a great one, Mark. Like that. Anyway.
So
go ahead, Tanya. I heard your voice.
we're absolutely beyond our time, but we want to thank you both so much for this very, not only insightful, very entertaining conversation between the two of you. I know I probably could speak for many of us. We can listen to you guys all day. You guys great insights. So again, I want to thank you both, and to our audience for joining us this afternoon. And we hope you found this webinar insightful and informative, and we hope to see you at our next event. Have a wonderful day, everybody.
Thank you, Tanya. Thank you, John.
Thank you, Tanya. Thanks, Mark. Yep.